Hello friends, welcome. I am here to give you an update on the debt markets for the month gone by and our expectations going forward. I guess the last one and a half months have been very volatile from an overall market perspective, whether it is debt, equity, currencies, commodities, etc. I think on the debt market side, there were three events that defined the kind of volatility that we saw, obviously starting with the October Federal Reserve meeting, where obviously the prognosis was more towards a potential rate hike in December. At the same time, we had an important state election result, which was not looked at very favorably by the markets. And finally, you had during the mid-month, last month, you had the recommendations coming out on the 7th Pay Commission that while very welcome from a specific industry and growth perspective, did raise some issues as far as the government's fiscal discipline or adherence to fiscal deficit targets was concerned going forward. I think because of these reasons, plus obviously a lot of geopolitical events that have been happening globally, which have created a lot of noise, there has been heightened volatility in the markets, combined with the fact that the markets for the good part of last 12 months have been time and again talking about potential Fed rate hikes. Finally, now that the thing seems to be crystallized for the month of December, is behaving slightly more volatile in that sense and is preparing for a potential Fed rate hike. With this backdrop, I think the most welcome thing was towards the fag end of this month when RBI came with its monetary policy stance. Not only did the monetary policy continue to remain unequivocally accommodative, which was again and again reiterated by the governor himself, but there were two very important positive takeaways from that policy. The first positive takeaway was obviously RBI's confidence in terms of how they viewed the government's ability to manage fiscal discipline in spite of the recommendations of the 7th Pay Commission. And second is that the RBI also mentioned that as far as the Federal Reserve decision was concerned, it was more or less factored in their own decision-making process, and they also believed that India, given its multiple positives on the macro side as well as on the growth front, would be one of the economies that would continue to do well in spite of this potential rate hike. And while we are on the rate hike, I would just make a small commentary here. Time and again, which we have stressed in the past, as we go towards the Fed rate hike, it's very important for all investors across asset classes to understand there is not the rate hike in itself which should be worrying investors. It is actually the potential of rate hikes going forward, and in that context it is almost unanimous that the potential for rate hikes going forward is not as high as we have seen in the past cycles because trend growth rates have come down, and that's the reason why as investors we are fairly comfortable that even when this rate hike happens, it might at the margin be taken positively by the markets because the event would have passed by. The second thing that I wanted to comment on is this ongoing volatility and what ramifications does it have for investors and how are we reading the markets. Now, if you look at the path that the debt markets have taken in the last 18 to 24 months, we have seen a secular kind of interest rate decline, but at the same time we have also seen various parts of the yield curve doing well at various points in time. So for example, between mid of 2014 till early 2015, it was the longer end of the yield curve which gave the maximum returns, whereas between March or April 2015 till date, it has been the short to medium term tenor part of the yield curve which has done much better. That was because of improving liquidity and curve steepening. So what I want to highlight here is that we do expect all parts of the yield curve to do well over the next 18 to 24 months, but obviously it will be at various points in time, and hence it's very important for us as investors to look at it from a slightly medium to long term perspective, especially when we are investing in any product category which is beyond the ultra short term category. So whether it is short term bond funds, whether it is credit funds, or whether it is income and dynamic bond fund categories, the investment horizons have to be 18-month plus so that you can get the benefit of that part of the curve working in your favor over the life of your investments. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.